Hi, my name is Trevor Gravink. I'm a real estate broker and mortgage broker, and I'm creating this video for first-time homebuyers, how to be able to avoid the most costly mistakes. Having done hundreds of transactions myself and actually managed over hundreds of loan officers, I've seen the good, the bad, and the ugly, and some of the mistakes that have been made that could have been avoided up front. And this whole presentation is to be able to go over that with you, as well as address some of the most common questions that I hear from first-time homebuyers. Now, I understand that buying a home is probably one of the largest investments that you'll make and probably the largest loan that you'll take. So, there's a lot of people that are concerned, stressed out, intimidated by the whole entire process. And so, this video is made to hopefully, take some of that stress away, make you more informed as a buyer so that when you start talking to real estate agents, you start talking to lenders, and you start looking at homes, that you can go in logically and also with questions to be able to ask people to make sure that you're putting yourself in the best position financially and to be in a home that you love and want to be in long term. But if you don't know what you can actually negotiate, what questions you can ask, then you really aren't informed enough and you're really relying upon them to be able to tell you about them. And not every person, real estate agent or lender, is going to be, providing you with all of your different options, maybe not maliciously, but just because they don't maybe understand all of the different, intricacies of your specific situation. And so we want you to be informed so you know what to ask to make sure that you don't miss out on potential ways to be able to negotiate the price down. Maybe there's down payment assistance programs that you can qualify for, or the best loan program for you specifically. So, some things I'm going to cover today. Number one, the most common question I get asked all the time is now a good time to buy? And then how to be able to choose a lender. The 10 most costly mistakes I see first time home buyers make, down payment assistance programs that you may qualify for, the true cost of buying a home, and then some credit tips and strategies to raise your score quickly. Your credit score is going to be the largest factor the lenders are going to look at for what rate that you qualify for. So whether you're looking to purchase 3 months from now, 6 or a year from now, we want to make sure that we start improving that score so we can get you into the highest tier possible because it can save you thousands of dollars. Now, I'm not putting this information up here to brag or anything like that. I just want to show you that I truly have helped a lot of people so that you know that the information that I'm providing you today on this video is coming from a place of actual experience. There's a lot of people out there that are just repeating and saying things that they've heard before. So, great, they might provide you with some information right now, but once you get out there and you start looking at properties, potentially getting in negotiations, something goes wrong during the appraisal process or during inspections, do they actually have the experience and the knowledge to be able to help guide you through those steps? So you can see here I was top 1%. I've done over 400 plus transactions. And like I said, when I was a part of a different mortgage company, I was vice president. I managed over 400 loan officers. So I saw a ton of sales contracts. I saw a ton of transactions. And that's what I'm going to review with you is just how to be able to avoid the things that I know that if they were planned out correctly, these people could have been able to put themselves in a better position from the beginning to make sure that they're, looking at the right homes, and then eventually when they do purchase that property that they're getting it at a good price with a great rate with the lowest fees possible. Now, I think it's not only important for you to know that obviously somebody's helped a lot of people, but do those clients actually have good things to say about them? Do they have good reviews? So, two places that you can look people up is Zillow and Google. And I would recommend before hiring a real estate agent or working with a lender that you look up their reputation online. And for the lender side, not only looking up who the lender is or the bank is, but also looking up the individual loan officer because the lender might be great. They might have, good scores, but then the actual loan officer that you're working with is very new and doesn't have a ton of experience. So you want to make sure that you're also looking up the individual person as well. Now, the first mistake I see a lot of first time homebuyers make is failing to plan a budget from the beginning. Now, when planning your budget, only you should decide what it should be, and you should base it on your personal economy, which I'll get into. According to a 2023 study by Clever Real Estate, more than half of home buyers, 56% of people, felt in over their heads financially since purchasing their home, and almost two-thirds, 62%, have struggled to make their mortgage payments on time. I don't want that to be you, and that's why this part of the process is most important. It's not the fun part. The fun part is looking at properties, but it's important that you position yourself first to make sure that you're looking at the right properties. Now, why do I feel that a lot of homeowners are feeling this way? Well, it really comes down to what a lender will actually loan you versus what you might actually be comfortable spending. So, some lenders will loan up to 55% of your gross income for all of your combined debt, known as your DTI or debt to income ratio. And many financial advisors suggest that you should use no more than 25% of your post tax income on your monthly mortgage payment. So, that's going to be a huge difference. So let's just go through an example. So if you're using your gross income and let's say you make $120,000 a year, that means you're making $10,000 a month. The lender is going to take 55% of that. So that comes out to $5,500. And then they're going to subtract any monthly obligations that you currently pay that show up on your credit report, like credit cards, student loans, car payments. And then on top of that, you might if you have child support or you have a monthly IRS payment or other things, then those would be deducted as well. They don't deduct things like Netflix, but things that show up on your credit report mostly. So let's just pretend that this person has $1,000 in other debts. They're going to subtract that from the 5,500, and the lender is going to say that this person can go out there and they can find a home where the total allowable housing payment would be $4,500 a month. Now, on the other hand, a financial advisor is suggesting that you use your post-tax income. So let's say that same person pays about 25% in taxes. Okay, so we take the 10,000, that would come down to 7,500 for your net income. And then they're saying take 25% of that to be able to fit in your monthly housing payment. So that comes out to $1,875. So we have $5,500, we have $1,875. That's a gap of $3,625. Obviously, a huge difference, and I don't want you to be part of that 62%. So you have to be able to kind of look down and look at your personal economy, which we'll get into. Before we do that, I want to get into what's included in the housing payment. So we're talking about the principal, the interest, the property taxes, homeowners insurance, and then any association dues if those apply, like HOAs. So when you are planning your budget, some things to consider is what is your personal economy? What do I mean by that? Well, how much debt do you currently have? Do you get annual raises? So a payment right now might be feeling a little bit tight for you, but let's say you get a 5% increase each year or a certain dollar amount each year. How does that calculate out, and does it make that payment a little bit easier for you? Do you and your spouse get raises each year? Okay, what does your financial look like 2-3 years from now? Also, comparing it to what you're doing right now, renting. If you're in a place where they keep raising your rents each year, it might be more advantageous to buy. Okay, also potentially, if you're moving a lot, there's a lot of costs in that versus once you purchase a home, most likely you're going to stay there for a longer period of time. Also, are you outgrowing where you're renting? Okay, are you planning on having kids, or do you have a kid that's growing or another kid that's coming on the way? What's going on in your housing market? So is it a good time to buy based on where you want to purchase? Is there a lack of inventory and a lot of the homes are going up and above asking price? Is right now a better time to buy? It's putting the buyers in the advantage. Now, obviously, rates are higher right now, but you can always refinance. But home prices most likely are not going to always fall in certain areas. Do you have an emergency fund? And then how long do you plan on living in this area? If you're only going to live here for 2 or 3 years, then just keep renting, save your money for the next place where you can actually settle down and buy a home. But if you're going to be, potentially in this area and you're fine with living in a home for 5 to 7 years, obviously longer is more ideal. But as long as you're kind of in that window, most likely you'll either be even or come out ahead. Now, the reason I brought up an emergency fund is there's other costs to consider when you're buying a home. And a lot of people say that a rule of thumb is to set aside 1 to 4% of your home's value for your maintenance fund. Okay, so when you're purchasing a property, if it's a new build, maybe you don't have to worry about your appliances. But if you're buying, obviously, a home that somebody's lived in for a period of time, how old is the dishwasher? How old is the washer and dryer units? Some of the larger costs, roof, air conditioning, plumbing. Okay, how old are these items? And then just general upkeep month to month. So, for example, I live on a hillside, there's rats, so we have to have somebody come out each and every month. That's a cost. Then we're on an air conditioning maintenance plan. Okay, to be able to keep the warranty valid, a lot of companies require that. So that's a new monthly cost. Remember that right now your landlord is paying for a lot of these maintenance fees, and so when you take over the home, that comes on you. So you have to be able to prepare for those things if something potentially happens. So some common mistakes I see when people are starting to budget is they look at homes based on their maximum loan approval. Now you might be saying, well, the lender says that I can afford this payment, so why not look at these properties? Well, are you correlating it to an actual housing payment? That's the key, is you should really work the other way, is looking at your income, how much do you want to spend each and every month on your housing payment? And then based on that, and the property taxes and the homeowner's insurance, you subtract all of that out, and then you say, okay, my maximum, principal and interest payment I want is this. And then you can correlate that to a loan amount, and then you can correlate that to what types of homes you can most likely afford and purchase. Also, miscalculating monthly amounts for property taxes, homeowners insurance, and private mortgage insurance if you're putting less than 20% down. So a lot of people, they go on to Zillow, they go on to realtor.com, they look at properties, and on there it lists the property taxes. However, that's not most likely what you're going to pay. In most states, once there's a new buyer, they transfer the property over. So at that point, it triggers a new reassessed value for that home. So now your property taxes are going to be higher because you're most likely paying more for that property than what that person originally did when they bought the home. So for example, in California, when it transfers ownership, in my area of San Diego, essentially they take the purchase price and they multiply it by about 1.25, and that's what I'm going to pay annually for my property taxes. So it's going to be much more than what was listed online. You can usually look up at the county what the actual assessed, how they calculate it. You can talk to a title company, or you can talk to your lender or real estate agent. Somebody should be able to provide you with how that calculation is made when a property transfers ownership. Homeowners insurance, it can be very costly in certain areas. Again, I live on a hill, so I'm in a fire zone, and so my insurance is much higher. Also, I need to carry earthquake insurance. So you need to look at where you're purchasing your property and how much homeowners insurance will be for you. Okay, in some areas like Florida, insurance is very high because of the hurricanes. In Texas, there's wind insurance that some people need. So do your research and figure out if you're going to need additional coverage or if your premium is going to be higher than what they're just posting online. Next thing is calculating payments using rates that are promoted online. Nobody promotes their highest rates. A lot of times, if you're looking at it, if you look at the fine print, what they're quoting you is a rate based on the best credit possible, so 780 plus. Maybe they're showing a rate where the person's putting 20% or 30% down on the home. So you need to read the fine print of how they're calculating it. And then a lot of times you can put in your credit score so it shows you what payment you might qualify for. The problem with that is you might be using a credit score from a credit app like Credit Karma, and that score is not the actual score that mortgage lenders use. So there's different types of credit scores, and there's a mortgage credit score, and it's calculated differently, and a lot of times it's slightly lower than what you're going to see on your credit app. Okay, so if you're utilizing that score, it might show you a lower rate, so you think this payment's going to be lower, and in actuality, your credit score is 20 points, 30 points lower. And so not speaking with a lender is a huge mistake in my opinion, because what we can do is we can do a soft credit pull. We don't need to do a hard credit pull, and we can see the actual scores that you have currently, and we can review your credit report together to look at your monthly obligations, and we can really budget out based on your specific financial outlook and what your credit scores are right now and what we might be able to do to improve those. But then you're using real numbers so you can get a true idea of what properties that you should be looking at. Now, in this market with higher rates, one option for some people, depending on your market, if it's really competitive, this might not be an option for you, but it is something that you should know about so you can bring it up to your lender, you can bring it up to your real estate agent, because it's something that you would need to put in the purchase contract when you're negotiating, and it's called a seller paid to on buy down, and that's the key. Seller paid, meaning that you're not paying for it, the seller's paying for it. And so what this does for you essentially is, I'm just using round numbers here to make it easy for you to be able to visually see, is let's say you qualify for a rate of 7%. Well, it's going to actually be bought down from that by the seller, and for the first year your rate's going to be 2% lower, so 5%. The second year your rate would be at 6%, and the third year through year 30 your rate would be the full amount, the 7%. The purpose of doing this is hopefully rates fall over the next 24 months and you're able to refinance during that period of time, so you never have to pay on that 7%. Or maybe you do get those annual raises, so even if you're unable to refinance during that time, by the time it gets to 7%, your income has gone up so that you're able to afford that payment a little bit more. Okay, so it's something, write that down, take a note of it. It's something that you should bring up and find out if it's a good option for you. Now, mistake number two I see a lot of people make is not interviewing lenders, and that's the key word that I'm using here and why I've underlined it, is interviewing. A lot of people, the very first question that they ask me is, what is your rate? Which I know is important because this is a large thing that you're going to be financing, but if all you're basing off of everything is the very first thing somebody talks about with their rate when you're purchasing a property, you might run into issues because there's a lot of lenders out there that there's ways to be able to tell you a lower rate, and then when you get down the road, it comes with a lot of different fees. So what you want to do is, one, come in with the right questions, which I'll show you what those could be, as well as be open-minded enough to give that person enough time to talk to you to show you your different options, because an FHA rate is always going to be lower than a conventional rate, but there's other costs with an FHA rate that you need to know about because potentially it's not right for you. Now, according to the Consumer Protection Bureau, only 47% of homeowners actually they only spoke with one lender, okay, which is pretty shocking because all of us don't have the same programs and options. So really, if you're only talking to one lender, you could be missing out potentially on down payment assistance programs from specific lenders themselves, as well as each lender has their own different, what I call, overlays. So there's the guidelines that FHA and conventional that you have to meet, but then lenders themselves might have additional ones. And so what the best qualifying credit score might be with one lender might not be the same with another lender. So even if you've been denied before, I have a lender that they don't work with people essentially below a certain credit score. However, that's their own personal overlay. Conventional, you can get a loan at 620. So it's really a matter of making sure that you're talking to enough people to understand that each and every single lender is not the same. So what are your options when it comes to mortgage loans and who can you get them from? Well, one, you can get them from a mortgage broker. Two, you can go to the local bank or credit union. Or three, you can do everything online through like a big online lender. Now, I'll get into kind of the differences between those and what might be more advantageous for you. But again, it's more likely that you should talk to a few different people to be able to see what fits your needs. So where can you find them? Well, first of all, you could ask me. In my description in this video below is a link for you to be able to talk to me one-on-one. You can also go to Zillow or Google and research different lenders online and look at the reviews. You can get a referral from your real estate agent or from friends and family, or you can also talk to your current financial institution. Now, when you're starting to look at a lender, again, look at their online reviews and reputation. And like I said, perhaps the lender has good reviews, but each and every loan officer has their own experience as well. So you want to look them up. All of us have our own license number, so you can look us up online by our name and our license. You can see more about us, how many transactions that we've done, if we have reviews online. Obviously, at some point in my career, I was a brand new loan officer. I didn't have a lot of reviews online. I still felt like I was good at my job because if I didn't know the answer, I had people on my team that could help me. So I'm not saying don't work with that person, but I would at least do your research and due diligence so you can ask that person, hey, I looked you up online. You don't have a lot of reviews on there. Just see how they react, how they answer to that question. Also, always ask the lender, do they do soft credit checks first and will they do a credit review with you? If we do a hard credit check, it will impact your score, and that hard credit check is only good for a certain window period of time, so we might have to pull your credit score again before you close. Also, do they do a credit review? Some banks, lenders, all they really want is the score so then they can see what your qualifying credit score is and then they look at the debts that are on there. They're not reviewing that actual credit report with you to ensure that it's accurate. And that's really important because if you have a common name or you're a junior or a second or a third and even potentially a not common name, there might be things reporting on your credit report that are inaccurate that are impacting the score that we're telling you. Also, when you have preliminary discussions with them, is the lender or person that you're speaking to just trying to push you toward an application, or are they doing a consultation with you first? There's a huge difference. I can, just send you a link, make you apply, and a lot of people do that because they want to get rid of the tire kickers, right? But that's not fair for you because this is a huge decision. It's much better if we can get on the phone. You can tell me in general what your income is, what your credit score is, where you're looking to buy, and we can have a conversation and figure out, is it even feasible based on what you're telling me right now? If it is, then I can give you a general idea of what payments would look like, what rates would look like, and then if you feel comfortable enough, then at that point, I'll send you my application link and you can fill it out. But a lot of people, they want to just send out the application, make sure that you can qualify, and then at that point, they might guide you in some ways. But if somebody just wants to send you an application link, that would be a red flag for me that it's more about them than it is finding about you and your particular situation. Also, you want to ask them, do they do rapid rescores? This is a process to be able to boost your credit score quickly to get you into a better bracket for your rate, which I'll get into. How quickly can they close? So some of the big banks, local banks, credit unions, they're not only just mortgaging on loans for homes, but they're doing all sorts of different banking. And so their process can be a little bit slower. Now, they might have potentially a good rate that you love. However, if it's a local bank or something and the listing agent knows that this process is slow and this bank never closes on time, they're going to tell the seller, hey, this offer, they're using this bank. I've been through this process plenty of times. They hardly ever close on time. So your offer might actually go to the bottom of the pile because of that reputation. So if you are going to use a bigger bank, make sure that they still will be able to close on time. Will they call the listing agent? So myself as a mortgage broker, anytime that your agent puts in an offer, I'm going to call the listing agent and I'm going to vouch that I've seen your credit score. I've seen your assets for the down payment. I've gone through your pay stubs. I've reviewed everything. We have a full entire package. I'm very confident that you're a good borrower. Also, that we're going to close on time. I tell them about myself. And basically, I'm just solidifying the offer for you. And you'd be surprised how few lenders actually do this. So it stands out to the listing agent. So if your offer is similar to somebody else, it could be the thing that potentially pushes it over the edge just to be able to have that listing agent maybe sell you just a little bit more to that seller so they choose your offer. And then do they only work 9 to 5, Monday through Friday? Most likely you're going to be looking at homes on the weekend, open houses. Maybe you want to run some numbers. You loved a few homes. You'd love to know what the property taxes are, maybe what the homeowner insurance is, the total payment. Maybe you need to make the offer by Sunday. When things are crazy during COVID, so many people would go to the open houses and they would get so many offers that they would do the open house maybe Friday, Saturday, and then there's and Sunday, and then they're going to choose an offer by Sunday night. Well, if your lender is closed and they can't talk to the listing agent, they can't talk to you, you're basically just going to go in there blind and put in offers on these properties. So, with myself and with a lot of mortgage brokers that you work with, you're going to get an individual person's cell phone number. You can text and call, and we can run through those numbers. Now, what should a good loan advisor do for you? One, they should review your credit report thoroughly with you to make sure that it's accurate. They should find out your short term and long term goals to make sure that you're choosing the best loan program for yourself. They should call the listing agent when you make offers, which we just discussed. They should prepare you so you're not scrambling. So if you do get that offer accepted, you're not trying to do the home inspection process, the appraisal, the stressed out of just knowing that you're buying a house, you're packaging up everything, you're telling your landlord that you're moving. There's so many moving parts, and they don't prepare you. Now you're trying to get documents and other things, and it can be overwhelming for you. If we know, if you're self-employed or W-2, 1099, in general, we should have a list of items that we've already gathered before this so you're not scrambling. We can help with negotiations if the appraised value comes in low, or potentially there's home inspection issues. Not only do you want obviously your real estate agent to be knowledgeable and be able to negotiate for you, but if there's even a second voice coming from somebody else that's been in the business and can talk logically about numbers and solutions for you, it's just going to be able to give you another person that can negotiate on your behalf. And then providing solutions and options to you. I talk to a lot of people, they've only spoken with maybe one lender, and that lender basically is telling them, hey, here's the rate that you qualify for, here's the program. They're telling them what they are going to do versus, hey, here's a conventional rate, here's three options, here's an FHA rate, here's three options, here's if you go with like a down payment assistance program. At the end of the day, it should be you that's making the decision of which program that you want to go with. And then also keeping you focused on your budget. So if you go out there, me and you have a consultation, you start saying this is the max payment that I'm comfortable with, and then all of a sudden you're sending me properties, say, Trevor, what's this payment look like? What does this one look like? And it's way up and above our original discussion. I'm not going to tell you that you're making the wrong decision, but I'll just say, hey, this payment's, going to be approximately this amount. This is about $300 more than what we originally discussed that you felt you were comfortable with. Just wanted to point that out to you. Okay. Obviously, at the end of the day, if you make that decision and you're qualified for a loan that will allow you to purchase that home, completely fine and up to you. But I at least want to be able to point that out because a lot of times emotion can get the better of people when they start looking at homes and falling in love with them. So some common mistakes I see when people choose a lender: one, failing to shop and interview lenders. Obviously each conversation with a lender might be 30 minutes, an hour. So they're just saying that they're too busy to be able to do that. More think of it as how many potential thousands of dollars it could save you by talking to somebody. So even if you could save $500 in total fees on your loan, is it worth that? Maybe just break it down. It's going to take me an hour to talk to this lender, potentially saves me $500. How much do you make on an hourly basis? Is $500 something you'd sit down for an hour? I would personally, and it could be much more than that depending on the rate. So yes, it could be annoying. However, it could save you a lot of money as well so that you're happy with the actual purchase of the property at the end of the day. Another thing is just working with the real estate agent's preferred lender. A lot of great real estate agents make sure that they vet their lenders, they have good lenders. However, I've been in the business a long time. Sometimes what happens is they still close on time for you. They do that job and they do that job great, but they know that because they're being referred lender, that potentially they're giving you a higher rate or more fee so that they can make more money because you're less likely to shop them because of the fact that your agent told them to go with you. Okay? So just because your agent says that, don't take just that one call. Still talk to other lenders so that you can hold that lender accountable to the actual rates that you should be able to get. Okay, I'm not saying that they're always going to do that. There's a lot of great lenders out there that will still give you the best rate and fees available to you. But working with a lot of loan officers, I do know that that does happen. Okay, then relying on the internet for all of your research. So you're just looking at rates online and then you're filling out forms based on that information and you're not talking to an actual human. Obviously, rate is very important, but at the end of the day, you want to make sure that you're in the right program because sometimes you might be looking at it as the lowest rate possible, but there could be other fees that you're not seeing. And so in actuality, it's not the best loan program. And so lastly, you're not asking enough questions to the lender. Well, it's hard for you to be able to do that because you're not in this industry. You most likely don't know what to ask. So below this is a link in my description, and it's a checklist of questions that you can ask the loan officer that you're on the phone with to ensure that you're at least vetting them to be able to get a good rate for yourself, to understand their fees and what programs and things that they're going to offer you. Mistake number 3 is overlooking government-backed loan programs and other grants and down payment assistance programs that might be available to you. Most first-time home buyers that I speak with, they don't know that there's many different programs that could help them with closing costs or down payments, and they rely on the loan officer or the lender to be able to tell them about these programs or the real estate agent. However, not all lenders do all programs, and then some lenders have their own down payment assistance programs. So you need to ask them what programs that they offer, and then also just be aware of some of the other programs that might be available to you through the city and the county. And I say that because some lenders don't bring them up because it's additional work for them. Okay, and so they don't want to do that additional work if they see you have a down payment. They just rather have you move forward with your own funds than them have to do additional paperwork. So there's different types of down payment assistance programs as well as grants. So grants is something that you never have to pay back. And then you have loans. They would be a second to the first loan. And some of them are forgivable depending on how many years you pay on it. And some of them you always have to pay it back when you refinance or sell the property. There's also something called a mortgage credit certificate. I also mentioned that cities and counties offer down payment assistance, and then some lenders have their own down payment assistance programs. And that's just another reason why potentially working with a mortgage broker is more advantageous, is because I'm not locked into just my bank's programs that we offer. Instead, I can go out to many different lenders, find the best program for you, and at the same time being able to shop the rates of all these different lenders. Now, how do you find down payment assistance? Well, you can go to your state's HFA website, which is the housing financing agency for your state. You can go to your city or county website to find programs. You can go to the HUD's website. HUD is just the U.S. Department of Housing and Urban Development. You can also ask your lender what programs they offer, and then as well you could ask me. I have what's called a grant finder and a down payment assistance finder. It's a program that I pay for. I put in the information and it spits out what programs you may qualify for. There's programs that are income based. There's programs that it doesn't matter how much income you make based on location. Sometimes credit scores are required for a certain amount of these programs. So it really comes down to your in particular situation of where you're going to buy to ensure that we find all the different programs and then we look at them and see if they're advantageous for you. Mistake number 4 is not being prepared for the total cost of buying. A lot of first-time home buyers don't know or prepare for the closing costs like title insurance, property taxes, homeowners insurance, and other costs associated with buying a home. Now remember, some of these fees could be offset by a down payment assistance program, a grant, or even seller credits, but either way somebody's going to have to pay for these fees. So there's earnest money and an option fee. You have your home inspection fees. If you perhaps need a secondary inspection, what else I'll get into, an appraisal, of course your down payment, your lender and title fees, and then your escrows for property taxes and insurance. And we'll break down each one of these so you get a better idea of what they actually cost and why you're paying them. So the first fees or money that you're going to put out there is going to be the earnest money and potentially an option fee. So when you find a home and you want to buy it, you're going to execute the purchase offer, and then you can pay 2 fees. One is refundable and one is not. So the earnest money It's commonly 1% of the purchase price. Might be different for your market, so your real estate agent will go over that with you because it is a point of negotiation. And this is your skin in the game. It's basically saying, if I pull out of this property, you could potentially lose that money based on different contingencies that you put into the contract. That money should be safe as long as the contract is written properly. If you decide to walk away, you'll still get that money back. If you go through the whole entire process and you end up purchasing that home, that money goes towards your closing costs and down payment. Now, ways that you could lose the earnest money will be writing offers potentially where you remove contingencies for like appraisals, the loan, your home inspection. But again, it's very hard to be able to do that unless you're working with an agent that writes a contract that makes it riskier for you. The other fee is an option fee. It's commonly between $200 and $400. This is also negotiated. This basically buys your time for the home inspection period. It's your 5 to 7 day escape plan. Now, you don't have to do an option fee. It's just basically telling the sellers that you're really interested in this property. You're very serious, and so your offer might go a little bit higher because if you decide to walk away, at least the seller's going to get that $200 to $400. Now, once you're under contract, the very first thing that you're going to want to do is have a home inspection done. And a general home buyer inspection is going to be between around $400 to $600, and that's always at your expense. Okay. Also, some lenders are going to require a pest inspection. They're going to search for like termite issues, and those are usually around $150. If you do have a good realtor, they might have a connection for a free inspection. And then that company obviously is just hoping that if there's termite damage that they're used, or potentially that you use them on like a monthly or annual plan to be able to check for termites if you purchase that home. So it's just a way for them to be able to earn future business potentially. Now, during the home inspection, let's just say that that inspector looks at the roof, they think it might be older, they only give it maybe 2 or 3 years of life left. Well, then you might want to have a secondary inspection done where a roofer would come out, look at the roof, and tell you, yes, you probably are going to have to replace this in the next 2 to 3 years. Here's an estimate of cost. When I purchased my home, the inspector pointed out that the plumbing was much older. He recommended that I have a plumber come out, and so we did. They did what's called like a video scope down. That costed around an additional $300, but they were able to tell us, yes, your pipes are going to need to be replaced. We got estimates from about 3 different companies. We went to the sellers and told them about this, and then we were able to negotiate from there.
Now, the appraisal is mainly for the lender. Obviously, you want to know the value of the home as well. Now, ideally, the appraised value is going to be at or above whatever you have in your purchase contract, and that the value is as is, meaning that it doesn't say subject to. If it says subject to, that means something needs to be fixed. Let's say there's a staircase that's broken or something. Essentially, they're saying they will not loan that money on that property until that staircase is fixed, and then it'll go from subject to as is, and that could be quite a few different things. So when you're looking at homes, if there are a lot of issues with them, just know that potentially there could be a subject to issue, especially if it's an FHA or a VA loan. Now, the lender is always going to use the lesser value of the purchase price or the appraised value to calculate your down payment. So let's just say you get a smoking deal, you do some great negotiating, the appraised value comes back at $450,000 and your purchase price is $400,000. That $50,000 can't count as your down payment. Okay, they're still going to want, if you're going to put 5% down, they're going to want 5% of the $400,000, because that way essentially you have a skin in the game, you have an investment into the property. Now, the average cost of an appraisal is going to be anywhere from $600 to $700 on a standard appraisal. If you do have a jumbo loan, if it's a larger home, then potentially the cost of that could be more. Now, let's talk about minimum down payments. If you're a first-time home buyer, and that doesn't technically mean that you've never purchased a home before. That just means that you haven't owned and occupied the home in the last 3 years. You can still be considered a first-time home buyer. If that's the case, then on a conventional loan you can put as little as 3%. If you're not considered a first-time home buyer with conventional, you can put as little as 5% down. FHA is going to be 3.5%. If you're a veteran and you qualify for VA, then you can actually get 100% financing, so you have to only put 0 down. Okay, you do have to pay for the closing costs. And then if you're doing a jumbo loan, you need to put a minimum of 10% down. And in a lot of cases, it only really makes sense if you're doing a jumbo loan if you're putting as much as 20% down, given where the market is today. That can always change, but right now, based on where rates are, you'd almost be paying more for points than you would be for putting another 10% down. Another cost is your escrows for your property taxes and your homeowner's insurance. A lot of people don't know, but you're actually paying your homeowner's insurance in full for the full entire 12 months before the closing of your home. You can either pay it up front, right when you get the policy, or you can pay it at closing when you pay the rest of the down payment and cash to close for the property. But either way, you're paying for an entire 12 months. And then also the lender's going to take approximately 2 to 3 months to be able to have that on hand, and then they're going to take through the escrow account a monthly amount to be able to make sure that next year when that policy is due, they can make the full payment again. So if you're in a state where homeowners insurance is more expensive, you know that you need to account for that. Most homeowners insurance, depending on the size of the home and some other factors, is around $100 to $125 per month. But if you live in a fire zone, a hurricane area, a wind zone, those places, the earthquakes where you need additional insurance, then you need to be able to account for those costs. And then depending on property taxes and when they're paid will be how much you have to come at closing for the actual property taxes. So when were the last taxes paid, and then if they're paid in advance. So sometimes homeowners are paying 6 months in advance for property taxes in certain counties. So that means that you actually have to come in with that 6 months, because the seller's going to get credited if they're not going to be in the home anymore. You're taking over, so you need to pay those taxes. So it's important that you work with a good lender that has a title company that can go ahead and make sure that you understand all the taxes that you're paying for, because in certain areas there could be city taxes, county taxes, and some other taxes that you pay for. Mostly, for most areas, it's just one, but sometimes it could be multiple. Now, the median home price across the country right now is around $405,933. That's what we'll just use for this example. So if you're going to do the home inspection and you need a pest inspection, that's about $800. Let's just say that you need a secondary inspection like I did for plumbing, $300. We'll do $650 for the appraisal. Let's say that you're going to go FHA, that's 3.5% down, so that's $14,207.66 for the down payment. Lender and title fees would be approximately $6,250, and then you have your property tax insurance. We're just going to estimate around $3,000. So approximate total cost would be about $25,207.66. Obviously, this is going to vary depending on your specific situation as far as insurance and taxes, but this is just trying to give you an idea of all the questions you should be asking regarding fees and what it might look like. Mistake number 5 I see a lot is thinking that all real estate agents are the same. Nearly 90% of home buyers do use an agent, but like anything, not all agents are created equal, and not all agents you should work with, because they might be a luxury agent and that's not the market that you're in. So make sure that when you're interviewing agents and you're talking with them, that they're on the same page as you and your goals. So you can find agents, obviously, if you go to Zillow, there's agents there, as well as on Google. You can get a referral from friends and family. You can also ask me. I have a database that keeps track of agents and how many of them actually work with buyers, so that you know that you're working with somebody that specializes in that area to make sure that they can negotiate the best purchase price for you, as well as, if they work with a lot of buyers, there's a lot of things that they might know to be able to point out to you to make sure that you're looking at everything when you're buying a house. Some common mistakes that I see when picking agents is people work with their friends and their family a lot. Now, they might be a great agent, but I've seen a lot of people work with friends and family members that are only part-time agents. They just carry their license for the purpose of, if their friends or family decides to buy a house, they hope they use them. They can make a few extra dollars each and every year doing that. Well, with that being said, if you're not in something all the time, the likelihood is that you're not up on the market. You may not know all the new rules. You're just not in a position to understand all the options that are out there for you to make sure that you're putting your buyers in the best position. I've dealt with this situation multiple times. Not going to get into all the different, horror stories of it, but make sure that if you're picking a friend or a family member, that it's something that they do full time and they have the experience. Another thought is that anybody can show you houses, and that's true. You could go out there and even just look at your own open houses. The thing is when you go out there with a good buyer's agent, they're going to point stuff out to you when you're at properties. Okay, they're going to make sure that you're opening up drawers and other things if you really like the home. I know it's just small things, but once you're going to get into the property, it's the small things that matter because they can all add up. And so you want somebody that's not only good at showing you homes, but then if you go under contract, then you really need a pro to be able to make sure that they're negotiating you the best deal. Then choosing the top local realtor. Okay, they might be the best option for you, but they may not, because they might not have the same type of knowledge where you want to purchase, as far as like condos, townhomes, the types of houses that you want. Maybe they're going to pass you off to somebody else on their team. So just make sure that if you're going to go that option, that you're not just saying, hey, they're rated the best, so I'm just going to automatically use them. Make sure that they meet your goals still. And then assuming because they're at the top of Google or the top of Zillow, that they must be good. Now that could be the case, but again, it might just be a sponsored listing, meaning that they paid to be at the top. So make sure that you're still looking at the reviews, that you're still going in with open eyes and questions to make sure that they're the right person, and don't sign anything right away, especially if you're purchasing this property with somebody else, that you have the meeting with that realtor, then you let them leave, and then you discuss it with your partner, and then at that point talk about who you like the best after you've met with a few. And obviously the same thing is, a lot of people don't ask questions because they don't know what to ask. So what I did is also put together a list of questions that I would ask each every realtor for yourself to make sure that they're going to meet your needs, as well as your timeline for purchasing a property. Some things that you should consider when you're picking an agent: obviously their online reviews and reputation. Did they take the time in the initial call and meeting to go over your wants, needs, and budget? Or were they just like, hey, great, I'm glad you're ready to purchase a property, you need to talk to my lender? Or hey, do you have a pre-approval letter? And they're just trying to basically push you to making sure that you're approved before they're even having a conversation. Because at that point, they may not be the best fit for you, but they don't want you, potentially, I guess, they think you're wasting their time. But at the end of the day, they should be speaking with everybody, giving them the time of day. And if they're not, that would be a red flag for me. And then also, will you be working with them or somebody on their team? I just talked about that. A lot of real estate agents have teams, and with buyers, they might pass them off to a newer agent, which might just be for the purpose of you being able to go out and look at enough homes and letting you into the house. But again, it's just something for you to consider. Do they have local expertise? And then did they present a plan and strategies that resonate with you? Meaning, if you are planning to try to move 6 months from now based on where you're currently renting and then where you want to live, kind of making sure that you're in a place to be able to do that, or what your options would be if you found a home that you really loved before your lease is up. All those things can be important to you. And then as well as if you need down payment assistance, how long that process might take, whatever the situation is for you. Do they understand it? And then are they on the same page with you? And then is the lender on the same page with the realtor and you as well? It's important that everybody is, so everybody's working towards the same goals. Mistake number 6 that I see is people looking at homes at the top of their budget, and pretty much those are the only homes that they're looking at. And by the top of the budget, I mean what the lender says that you're approved for the loan, and then obviously your down payment on top of that. So if you have $25,000 for your down payment, and they say that they'll loan you up to $400,000, then that's $425,000, and you're looking at homes that are listed for $425,000. And we know that you want to buy a home that you love, so it's tempting to look at homes at the top of your budget, but a lot of times those might go over asking, or you might be calculating just numbers so tightly that at the end of the day you may not get approved for that property. Another reason is you want to just get a good idea of a lot of different homes, right? What does a $400,000 home look like compared to $425,000? So you can see, is it worth it? Because a lot of times the ones that are at the top of the market might just be fix and flips. They did a little bit of paint here and there, and you're really just paying, a higher dollar amount, and you could maybe do some of that small stuff yourself. But again, it's just a matter of looking at enough properties to make sure that you're comfortable with whatever decision that you make. So where do you find properties? Obviously, you can look at Zillow and other online sites, and then your realtor should send you suggestions as well. So after you have that initial conversation and you figure out, what type of property that you want, then what they should do is take the large amount of properties in that area that are up for sale, and then they should actually go through them, say, hey, these are the ones that fit, number one, your purchase price and budget, number two, the square footage you want, beds and baths, other type of features that you need, and then they send you, 5 homes to look at instead of 40 homes to look at. You have a full-time job. You don't have the time to look at all of these properties. Obviously, if you want to at the beginning, that's great, but really that's what a realtor is there to do, is to learn what you want, have some ideas after they sent you some properties, and then narrow it down for you each time, so that then you can pick and choose and be more picky about which homes you actually go to in person. Some common mistakes I see when people are looking at houses is not accounting for association fees. So if you're in an area, like I'm in San Diego, you're buying a condo or a townhome and there's a lot of amenities, those association fees can be $500 a month in some cases. So that could really impact the housing payment and what you qualify for. So a lot of people forget to add that in. They're just looking at the principal and interest, property taxes, and insurance and think that they can afford the property. They might put an offer in over the weekend without talking to the lender, and at that point they come back and they don't realize, oh, we don't qualify for that home. So make sure, if you're looking at homes or condos, townhouses, anything with association fees, that you're making sure that that's in the actual housing budget. Estimating too little for property taxes and homeowners insurance. So a lot of people look at Zillow or those sites, they look at the property taxes and they say, oh, this is, $3,000 annually. Well, that's not actually accurate, because in most states, when a property is sold, transferred to a new owner, that property is reassessed and then the property taxes go up. So for example, in San Diego, where I'm at, it's basically 1.25% of the new purchase price of the home is going to be the new annual taxes. So if I'm looking at somebody that's lived in this home for 15 years, it's going to look like the property taxes are much less than they will be when it's reassessed. Homeowners insurance, again, we've already hit on it. If you live in an area where insurance is higher, you want to make sure that you speak to somebody up front, you get some quotes so you don't get shocked by that as well. Relying upon online sites to provide payment estimates. So what I mean by that is for the principal and interest, a lot of sites, you can plug in what you think your credit score is and what you're going to put for a down payment, and it's going to show you a rate and then give you a principal and interest payment and maybe even suggest what they think the property taxes and homeowners insurance will be. Well, a lot of times the rates that they're quoting might have points or extra fees built into them. So you want to make sure that you're reading the fine print. You're not just utilizing that you're actually starting to run these numbers by a lender that you trust. So if you like a house, just send it over to them and say, hey, is this a house that meets our budget? What would my payment look like? And then you do a lot of your research online. So you're not passing this information back to your lender or your real estate agent, and you're relying a lot on the internet, which obviously, is very beneficial in some cases, but in other cases it can almost be overwhelming because there's so much different information out there. And most of the sites that you're looking at is trying to get you to fill your information into their site so that you can basically be a lead, and then they can get your business as a real estate agent or as a lender. So a lot of times they give you some of the information, but not all of the information. So just be cognizant of that when you're going on there. Some things to consider when you start to look at properties is, do you even want to have an HOA? Okay, some people love them because they don't want the neighbor that parks their car in the grass or has weeds that are 1.5 foot tall. But then other people like the uniqueness of neighborhoods, and not all the homes look the exact same, and they don't want somebody to tell them how to keep their house kept, and some HOAs can be nightmares, and they've had that experience, so they don't want them anymore. So make sure going in that if you don't want an HOA, you let your realtor know so that they don't go into those homes or those areas that would have an HOA. Or if you're open to it, then if you start to actually go and potentially put an offer in on a property, that you learn about that HOA and do a little bit of research. And then, does the neighborhood that you're looking at, do they have good schools? maybe you don't have kids at the moment, so you're not really thinking about that, and then all of a sudden you do. Now the school districts are not good in that area, and now either private schools are really expensive, and you have to make some decisions on, do we send them to that school, do we have to send them to private school extra money, do we have to move to a different area? So just something to think about. And are you near things that are important to you? Now things might be changing on what's important to you today versus what's important to you in 2 or 3 years, but I've seen people move out to the suburbs thinking, hey, it's not a big deal, it's more house for what I can afford, but then all of a sudden they're away from a lot of their friends and family, maybe even their work, and there's a lot of traffic, and so then 6 months, a year from now, they're a little bit more, not as happy in the situation where they were, if they were closer to those areas. So strategy or tip, and something that I do with all of my buyers, is after you've dialed in the type of home that you want, so square feet, beds, bath, yard, price, etc., you want to ask your realtor for the last 12 months in the areas you want to live, so you can see the original listing price and the actual sales price. So all the homes that have sold in that area in the last 12 months. So you can get a good idea. Did a lot of the properties go for asking, under asking, or over asking? If they went over asking, by what percentage? And then the homes that did go over asking, I would look at those and look at the pictures and say, what potentially made these go over asking? Was it that they were fixed up? Did they have pools? What was it that maybe had it go over asking, so you can be prepared if you're looking at that type of home. Or maybe it was all within a certain period of time where rates had a slight drop, right? And so people got excited, buyers came in, and maybe that spiked it up a little bit. We want to just kind of look at and prepare ourselves for potentially having to go over asking, or knowing if you look at a home and you put an offer in, the likelihood of getting it is pretty slim, so you don't get your hopes up. Mistake number 7 is not knowing your negotiating options. Remember that pretty much everything in the transaction can be negotiable. So once you get under contract, though, a lot of times emotions get the better of you. So you just want to get an idea up front of what things you should be thinking about, potentially negotiating on. So you have your sales price, who's going to pay certain closing costs, the time of inspection period, what happens if there are repairs that need to be done, or you find things when the inspection happens. If you're going to ask for seller credits, what fixtures in the home are going to stay with it, so washer, dryer, fridge, those types of things. And then if you're going to have the seller pay for like a home warranty plan, so that you have everything covered for like the first 12 months that you're in the property. So what you should consider when you start putting offers in is how many houses like this have been on the market in the past 12 months. If it's a very unique property and you absolutely love it, and you saw a lot of people at that property, let's say it's an open house, then you might have to go over asking or go up to your top end of your budget. Okay, how many days has it been on the market? Has it been a few days? Is it a brand new listing? Or is it past 30 days? Who is the seller? Is it a fix and flipper, a builder? Maybe it's somebody that's lived in the home for 20, 30 years. Now you may not be able to get this information, but in a lot of cases you can, even just through the title company. They can tell you who owns the property and for how long. And then on a scale of 1 to 10, how much does this house meet your wants and needs? If it's a 10, you really want it, again, you might have to go over asking or up to your top end budget. If you're at a 7, then why not, potentially not go in at full asking or ask for seller credits, because if you don't get it, then there's not really that much lost. Now you don't want to throw out there just offer after offer that's a low ball, because it will potentially frustrate you, but also your realtor does have to put work in for that. So just know that going in. And then lastly, are you prepared if it's a fixer-upper? If it does need work, how much work is it? And ideally, do you have the money capable of being able to pay for that if you have to hire a professional to be able to do it? And then do you like the neighbors in the neighborhood? And if you really love a property, you're going to put an offer in on it. I would suggest, if you're looking at it during the day, which I would assume most people are, then you go to that property and you look at it at night. Or vice versa. If you're looking at a property after work and it happens to be pretty dark, make sure that you go to that property during the day. Now if you're in a competitive market, here's a strategy or tip that might work for you, and it's called an escalation clause or an escalator. And basically what this means is, let's just say that you're willing to go over asking. Home's purchase price is at 500, you love it so much, you'd be willing to pay 550,000 for this property if you were able to get it, right? But you don't want to have to pay that $50,000 extra just because you want this property, right? You only want to do it if you have to do it. And so how that contract can be written is you can actually put in an escalation clause, essentially meaning if there's any offer that's like you put your purchase offer at 500,000 with an escalator up to 550,000, you're saying that you'll do $1,000 over the next highest offer. So if they offer 530,000, you're basically saying that you'd offer 531,000. If somebody came in at 555,000, you would lose out on that property because you're only willing to go up to 550,000. If that doesn't make all the sense in the world to you, just ask your realtor about it. They'll know about it. It's not a strategy for everybody and not in every market. Mistake number 8 is not using your mortgage credit score, and this is really just because people don't realize that there's different types of credit scores out there. Your credit score is going to be one of the largest factors that's going to impact the rate that you qualify for when you do close on this home. So if you're about to purchase, why not make sure that we're putting you in the best position when it comes to your credit score? Usually with a lot of lenders, 780 plus is going to be the highest tier. So if you're not above 780, then there's a little bit of work that can be done to potentially lower the fees for the rate or just get you into a better rate. So there's a mortgage credit score, and then there's like your consumer credit score. The mortgage credit score is a little bit different. It's made up of 35% of your payment history, 30% of your credit utilization, 15% of credit length, 10% of credit mix, and then 10% of inquiries. Now the score that you see with like Credit Karma or on your credit card apps, they're actually using the Vantage 3.0 scoring model, so you can see the percentages are different here. 40% payment history, 21% age and type of credit, 20% credit utilization. So these scores typically, when you're on Credit Karma, are going to be higher than what your mortgage score is because you've never had well, I'm not going to say you don't have a mortgage because you might be purchasing a new property. But if you have no mortgage history, then potentially it can be a little bit lower for you. And truly, 1 point can cost you thousands of dollars or a totally different rate. So lenders typically, depending on the mortgage product, this can vary, but let's just say for a conventional loan, one of my lenders, this is their bucket. So this means that everybody at 780 plus is in the same bucket. 760 to 779, 740 to 759, and so on. So if you're at 757, you're only 3 points away from getting into the next bucket. There's ways to be able to potentially increase your score rather quickly, so you need to know and ask the lender, like, how close am I to being able to get a little bit of a better rate from you? There is something called a rapid rescore, which we can actually provide you with the details for you to raise your score quite quickly within a few days. And we can look at a real life example here that I worked with some clients. So anytime that we pull your credit score, if there is a co-borrower, we're going to use the middle score of the lower person. If it's just you, then it's going to be the middle score of your 3 scores. It's Experian, TransUnion, and Equifax. In this example, when you're looking below, it was the co-borrower and their middle score is 757. But then below all those scores, you can see that blue number. You see plus 34, plus 31, plus 54. That's the actual opportunity for the score to be able to go up by that much through the rapid rescore option. Now, how do we know if it'll work? Well, there's something called a wayfinder, and essentially it's going to show you what you need to do to be able to get that score up and what the likelihood is. So with this, it says it's 96% likely that you would need to pay down $123 on 2 different cards, and that would impact your score immediately. Now the system does give detailed instructions, so you can see it tells you exactly the 2 cards that need to be paid down, and that one needs to be paid down to 0, and then the other one needs to be paid down from $4,795 to $4,127, and then with 96% likelihood, it's going to put your score over 780. And all we need is a letter from the creditor stating that the new account balance. With this client that I worked with, that card was actually at a 0 balance. It's just the last time that that credit card reported to the credit agencies, there was a balance on it. So with these borrowers, we did do the rapid rescore, and then 2 to 3 days later, we did get the updated score. The new score was 792. So then we actually were using the main borrower's middle credit score, which ended up being 780, which put them into the top tier. Now these borrowers were buying a home in San Diego, which required a jumbo loan. So by getting their score over 780, it actually lowered the fees of the loan from $12,410 down to $6,115.20 for that rate that they qualified for. In this instance, that saved them $6,294 in fees at closing for the same exact rate, just because we were able to bump their score up above 780. Now, it's important not only to ask your lender about what their credit buckets are and how close you are, but do they actually do rapid rescores? Some lenders and brokers don't do rapid rescores, and the reason is it really just comes down to money. They can't charge you for this fee, and the credit bureaus do charge us. So in this instance, for this rapid rescore for my clients, the total charges to do it were $146.50. Now, why some lenders and brokers don't do it is because if those borrowers were, let's say, to walk away from the deal, go to another lender or something, then they're out that money, right? Well, I'd already established a great rapport with these people. Obviously, I helped them out a lot by getting their credit higher. If for some reason they did go to another lender, it's very, it just happens. But I'd rather do the right thing for them and put them in position for the best rate and fees possible. So you want to make sure that the broker or person that you're working with is willing to do so for you. Besides a rapid rescore, some quick ways for you to potentially raise your score before you get out there and start buying a home. And one is to be able to just call your current credit card companies and ask for an increase if you have utilization on the card. So let's just say that your current credit limit on a card is $5,000. You currently have $2,000 on that card. That would be considered 40% utilization, right? And let's just say that you don't have the funds to be able to pay that card down to zero or even to 1,000. Well, you could call that credit card company and ask them, hey, can I get a credit increase? And let's just say that they bump it from 5,000 to 10,000. Just by doing that, which didn't cost you anything but a phone call, now your credit utilization is at 20% instead of 40%, which can raise your score. Okay? Also, it depends when you pay your cards. Do you pay your cards when the actual credit card payment is due, or do you pay it right before the end of the statement date? So there is a difference. When you're looking at your end of your statement date, that's what's going to be reported to the credit bureaus. So you want to make your payment just a few days before that, even if it's just for the few months that you're out there shopping for a home, because what's then going to be reported is whatever you have. So if you pay your cards down to zero and you do it just when the actual payment is due, it's not going to actually show up as zero on your credit report. It's going to report based on what was on the last statement. Okay, so that's why a few days before the end of the statement date, which you can find on your statement, you want to pay it then. Okay. Also, if you don't have a lot of credit history, you can report your rent and other utilities. And then I do see a lot of people getting like gifted funds to be able to purchase their property from family members, parents, other people. So with that, obviously they're trying to help you out. They want to get you into a home. They know how hard it is in this market. So if they're willing to help you out that way, they might be willing to help you out this way, which can increase your score. If you have somebody that you can trust and they can trust you, they can add you as an authorized user on a credit card that they've been making good payments on for a long period of time. So let's just say they have a credit card that they've been making good payments on for 5 or 7 years, something like that. They add you on as an authorized user. You get all of that good payment history added to your credit report. Okay, so that can really increase your score really quickly. Lastly, you can always talk to me and my team. We'll review your credit with you to see if there's any other ways to be able to impact your score quickly, or potentially it takes a little bit of time, but at least you know when that might be that you can go out there and start looking at homes. Mistake number 9 is getting under contract for a home and then you kind of allow emotions to take over. You want to remember, after your offer is accepted, you can still negotiate after the home inspection comes back. And if the appraisal comes back lower, these are points where you can still go back to the seller and ask for seller credits and other things. So let's say you have the home inspection done and there's some issues that need to be fixed. Okay, and you go to them, like for example, my house, there was a plumbing It was going to cost around $12,000 to be able to replace the plumbing. So we had a couple different options, right? We could terminate the contract. We say that's more problems than it's worth. We wouldn't want to deal with that plumbing, and we just walk away. Okay, within our inspection period, we have that contingency. We can walk away from the home. We can also ask the seller to fix the issues. Okay, that means that they would have to fix the plumbing before we actually close and they hand the keys over to us. That's not really a likely scenario. To fix all the plumbing within 30 days, they're going to have to rip up a lot of stuff. It's going to be a headache for somebody that wants to sell their home, right? So most likely they're going to say no to that, but that is an option. And then the last option is to negotiate for seller credits. And this will reduce your cash to close, so you have the remaining cash when you take ownership of the property to then do the fix up yourself. So in our case, we asked for the $12,000. The seller said, we'll meet you halfway, we'll give you $6,000, and we accepted that offer. So you always have that option, you know, when you're going past the home inspection to be able to kind of renegotiate in some ways. Now once you have the home appraised, the value comes in low, you have a few options. So let's just say that the purchase price of the home is $400,000. The appraiser goes out there and they say that home is worth $380,000. Well, we have a problem. We have a $20,000 gap between the $380,000 and the $400,000. Okay, so the first step, as far as me on the lender side, I'm going to ask for a reconsideration of value if I feel like the appraiser didn't do a good job, meaning that they didn't use comparable properties in the neighborhood that I was able to find, working also probably with the listing agent and the seller and the buyer's agent to try to find other properties that we can utilize to hopefully get them to reconsider the value. If they won't do that, then there's different ways that we can potentially restructure the loan to try to still make everything work, or we renegotiate the sales price. And that might be that you come and say to the seller, hey, we can only go up to $380,000 because that's what the home is valued at. They might say, we'll come down to $390,000, and now you need to come up with $10,000. Either way, if we do the reconsideration of value, we try to restructure the loan, we do everything on our end that we can try to do, then, you know, myself, the buyer's realtor, we can talk to the listing agent, tell them here's where we're at, and we can try to do some negotiating for you. And if you have a good lender, loan officer that can, you know, detail out everything and all the steps that we've already tried to do to solve the situation ourselves, and we're at kind of a standstill, we can't do anything else, then more likely they're going to go to the sellers and say, hey, we're going to lose this deal unless you're willing to give a little bit here or there. And the last mistake that I see a lot of people make, number 10, is getting your info from the news or social media. Now, where the market's at today, there's a lot of news and there's a lot of clickbaity type articles, you know, with headlines on certain things to try to get you to click because they want to make money or they want to generate a lead. Okay, so given that, you want to make sure that the news that you're reading is local and that it's actually an impact on your market, or else you just kind of show it as irrelevant. The same with like interest rates or mortgage rates. The news say, hey, rates fell today or they spiked today. Yes, that can kind of happen, but it doesn't move the same way that they state, but really they're trying to get you to click on something. If you want to know today's rates, reach out to your lender, reach out to me, we can go over what the rates look like now. They don't move as much as the news likes to make you feel like they do. They just want you to click on more articles. Also, if you're looking, you know, at buying a home, most likely you're getting, you know, tagged, pixeled, however you want to look at it, and different things are going to follow you around on the internet. You're going to see more things, and so that can be a little bit confusing to you because more marketing is going to come to your way, especially like social media. If you're scrolling and you're liking things that have realtors talking or loan officers talking, you're probably going to get more of that. Just make sure if you're following somebody, you're listening to their advice, that you take the time to move off the social media platform and you research that individual person, see if they have good reviews online. A lot of people are just repeating things that they've learned before. They actually haven't done a lot of transactions. So some things to consider. Is it local or national news? Does it sound too good to be true? Does the article have marketing all over it? Are they just trying to turn you into a lead? And then have you vetted the social influencer? Now, given everything that's happening in the news, a lot of people ask me, should I wait? Well, a couple things to consider, and this isn't for every single market, so check yours. But in general, supply of homes for sales nationally are down 71% since 2007, and that's because when the crash happened, builders stopped building, and we've never caught up since. So when there's lack of new homes being built, there's lack of inventory, there's lack of homes, which obviously creates a supply and demand issue, which makes the price of homes continuously to stay higher and keep appreciating and keep going up. Another factor is there's just more people that are at the age of purchasing their first home, because we had the baby boomers. Well, they had their own kids, and there's a lot of them right now that are between the ages of, the 30-year-old range, which a lot of people are purchasing their home. And there's more of them right now than there are homes to be able to buy, which inevitably makes the price of homes go up because people are willing to overpay for properties. So if you're going to stay in a home anywhere between 5 to 7 years, I really don't think you'll lose, because if you look at the long-term housing market, you can see since 1942, home prices have appreciated 71 times, they've gone down 6 times, and they've been flat 5 times. Now, 5 out of the 6 times was from 2007 to 2011. We all know that was the market crash. The market crashed because there was loans out there that were, predatory loans. People were getting money out of their properties, and they were buying homes without having to show income. That's no longer happening. So the people that are qualifying for homes can afford them. And then you have a lot of people that are locked into very low interest rates, so they're not willing to sell the home. And that's what's kind of compounding the problem with sales prices of homes not dropping. So when you are online, first of all, don't just read the headline, read the full article. Remember that most national news doesn't apply to you. Work with a loan advisor that will look at things and send you them and verify what's accurate for your situation. So if you see a news article that says rates drop, ask them how much they've actually dropped. And then obviously get a personal economy analysis, which we've discussed a few different times, and I'll go through what that means. The first step in a personal economy analysis is, if you're renting, is that we do a buy versus rent analysis. What are you paying for rent right now? How often and how much are they raising your rent by? How does that compare to a housing payment? And then what happens, during that period of time if you have to move and those costs. Sometimes it can be hard for you to understand all the different fees on the buying side of the transaction and the appreciation that's going to go on with a home, rent increases for your area. This actually calculates it all out for you, so you can get a clear picture, is this the right for me? Now, based on your situation, it may not be the right time 6 months from now, a year from now, 2 years, 3 years. We also have a cost of waiting calculator so that you can see what it might cost you if you plan to purchase a property 3 years from now. If you're in an area like I am, where home prices just keep going up, I'm in San Diego, there's not really any new places to be able to build unless you move out to the suburbs. Homes are going up each and every year by, let's say, 4%. Well, 4% of average home price out here is $900, $1 million. 3 years from now, that house is going to be a lot more expensive. So you got to think about those factors, and you want to do that with a loan advisor that can put in all the correct numbers with you and give you the best facts so that you can determine what's best for you and your family. And then lastly, we want to do a credit analysis. Are there ways to be able to improve your credit score so you can qualify for a better rate, which would obviously reduce the payment or help you qualify for a larger home? And then also, is everything accurate as far as the different minimum payments that are being put on your credit report, because that can impact what you can qualify for as well. If you would like to talk to myself and go through your personal situation and your personal economy, then you can just go ahead and scan this QR code. My calendar will pop up, and you can schedule a time to be able to sit down with me, go through all of your options. We'll go through, the rent first buy, what your goals are, what your current income is, the max loan amount that you can qualify for, but then what you're actually comfortable with a housing payment. Regardless if you're ready to purchase now, 2 years from now, it's all okay to be able to schedule a time with me. It's best for you to position yourself way ahead of time than it is to wait till the last minute, because we can prepare you a lot more for what might be a way for you to be able to get into a home even quicker than you might think is actually available to you. So you can text me, you can email me, or again you can scan this QR code and schedule a time to sit down and we can go through everything. If you got into this part of the training, then I appreciate you going through the whole entire thing. Hopefully you learned some things that's going to put you in a better position when you're ready to start looking at homes and purchasing. I hope that I get to speak with you individually one-on-one and be able to answer all the questions that you have, and hopefully